Before I discuss today's topic, I just want to get some prereqs out of the way. I am not a financial advisor, a tax specialist, a doctor, or a lawyer. This is not meant to be a financial, medical, tax, or legal advice. I'm only sharing my failures, learnings, and successes. Never blindly follow a stranger on YouTube or the so-called expert on stock picking without performing your own research. I intentionally opened this account back in March of 2020 when there was fear, uncertainty, and doubt, both in the job market and in the financial market, for two purposes. The first purpose is to show that the best day to invest was yesterday, and the second best day to invest is today. The second reason is to show wealth accumulation is slow, simple, and boring. All you need to do is consistently buy into the market with dollar cost average. Dollar cost average, also known as DCA, means you invest equal dollar amounts at a regular interval regardless of the market performance. If you contribute to your employer-sponsored retirement account such as 401k, you are essentially dollar cost averaging into the market, where every pay period the same amount is deducted from your paycheck and purchase shares and funds that you selected. The benefit of DCA is you take your emotion and the performance of the funds out of the equation. Instead of timing the market, you're only focusing on time in the market. This method has proven to reduce stress and maximize your return in the long haul. M1 Finance is my favorite fintech brokerage account, and I've used Robinhood, Webull, Schwab, and Fidelity. While those firms do offer commission-free trade and fractional share purchases, M1 Finance has a feature that others do not. I can create my own fund. M1 Finance call it PI. Once the fund or the PI is set up and direct deposit is linked to M1 account or from your employer, and the asset allocation for the different slices along with their percentages, and auto invest is turned on, now it's on autopilot. Your first initial trade, you need to have a minimum of $100 to start, but after that, all you need is $25 minimum balance, and if you have auto invest turned on, it will automatically purchase based on the percent allocation that you set. So if you have money in there and if you receive any dividends, it also get reinvested. Since I started this account March of 2020, it has been on autopilot. Every Friday, $100 get deposited into the account, and Friday at 9:30 a.m. it will make the purchase based on my asset allocation percentage. And if I have an asset allocation that is overweight and you have asset allocation that is underweight, it's gonna make sure to purchase the underweight asset allocation and ignore the overweight ones. How sweet is that? It may even be sweeter than the real pie. It's a shame that M1 Finance doesn't get the recognition that it deserves. Maybe because it only has one trading window, unless you are M1 Plus members, which is a $36 a year or $3 a month membership to get the additional second trading window in the afternoon. For people that like to trade in and out of the market, buy individual stock, and time the market, having only one trading window or even two trading window may not be enough for them. But for me, as a long-term investor, this is great. I love it. I love having my wealth accumulation on autopilot. After all, I have better things to worry about. I name my portfolio, my pie, as Automate Your Way to Wealth. And as of March 4th, 2024, it has a value of $33,770.12. My cash flow was $27,559. So far, I have earned $1,724 in dividends and a market gain of $6,210. That's a money weighted return of 54.27%. I have a 28 position my cost basis, current value, unrealized gain of $6,212. And these are the individual companies that I invest in. Nothing fancy there. In 2020, the dividends I received was $83.19. 2021, I received $317 in dividends. 2022 was $472. 2023 was $656. And 2024 so far, $76. Not bad at all. Dividends are typically paid out on a quarterly basis, but because I have 28 companies total, it seems like I almost get dividends on a monthly basis. And when I first started receiving dividends, my first 8 dividend checks, they were all under $10. But as time goes by, the dividends start to accumulate. The compound effect really does wonders. And now if you look at my best month in terms of dividend that I received, it's $120. Do you know what you can do with $120 a month? So right now, just 4 years into investing in this portfolio, I can pay Netflix, Hulu, and the internet. And if I continue to invest on a regular basis, soon it can help pay for utilities. Soon it could potentially help pay for homeowner insurance. So you get the picture. I compare investing to gardening. I call it the garden of wealth. As long as you continue to have the seed money, when you take your earned money, your earned income, and you plant it in the stock market, as the dividend grows and as your stocks or funds grow in value, you can choose to harvest it. And when you harvest the profit, the dividends, you still have the seed money to keep on growing garden of wealth year after year after year. That's wonderful. There's a reason why I chose to have direct deposit 400, because that is roughly how much Americans are paying on a monthly basis on a car payment. Do you need a car? Do you need an SUV? Do you need a minivan? Absolutely. You need that for transportation to take you from point A to point B. But do you need a brand new car? But do you need a luxury brand? To me, the purpose of a car is to take me from point A to point B safely, economically, and reliably. That's why over the last decade, I have purchased vehicles that were around 80,000 miles to 120,000 miles, and I paid them in cash. Now I save money not only not having the car payment, but also my insurance is cheaper, because instead of worrying about covering the full coverage, I'm only paying for the POPD. Because the car is so cheap, I can buy another one if I want to, if I need to. 2 of my cars are over 210,000 miles today, and it's still running strong. If you don't have a car payment and you're still struggling to find investable cash, I would encourage you to look deeper into your budget to see if you can cut down life's convenience. Starbucks, eating out, and subscriptions that you subscribed many years ago and you totally forgot about it. Any amount that you can find that you can put it to work is better than nothing. If you can only find $20 a week, that's great. $30 a week, that's great. Anything is better than nothing. I won't go into too much details on M1 Finance, the features, the fees. You can go online and read up on your own. So if you go to m1.com, go to the main site, it tells you it has over 6,000 stocks and ETF, no commission trade. It is SIPC insured. What that means is it protects your fund up to $500,000. But if you made the wrong investment and your investment goes down to zero, you're not going to get that money back. It's just protect your money just in case M1 Finance no longer stay in business. And you can read more about it down below. It also have a savings account at 5% APY, but to get that you need to be an M1 Plus membership. I don't use this. You can scroll through the investment section, how the pie works. Then they have multiple account types here. They have individual brokerage account, a joint brokerage account, and custodial account. This is different than the 529. Then the retirement accounts, they have traditional IRA, individual retirement account. They also have Roth IRA and SEP IRA. And then other account, crypto and trust. For me, when I use the M1 Finance, I only use it for individual brokerage account, which is a taxable account. And I do have some of my Roth IRA in here as well. So I hope you get excited over the potential of automating your wealth through M1 Finance. And if you are excited, now let's get into how to get started. To set up M1 Finance is fairly straightforward. It's self-explanatory. You just need an email, create the password, and provide all the documentation that they request. Social security number, driver license, just to ensure that you are who you say you are. Before I go into how to set up your own pie, let's go over how I set up my pie back in 2020. This pie or fund, I call it the fund, but M1 Finance call it pie. I call it Automate Your Way to Wealth. And this fund or pie has 7 slices: financial, or I call it sector, financial, healthcare, technology, consumer, industrial, communications services, and ETF, exchange traded funds. I have an asset allocation. I want 22% to go into financial. I want 19% to go into healthcare. I want 15% to go into technology. 16% goes to consumer. 15% goes to industrial. 10% go to consumer services. And just a mere 3% go to ETF because I like to pick my own fund. And if you click on the financial sector or slice, you can see that I have JP Morgan, Bank of America, and Wells Fargo. And even within the financial, I can also tell M1 Finance what percentage I want each of the company. 2% to Wells Fargo, 48% target for Bank of America, and 50% target for JP Morgan. And then healthcare, same thing. Technology. My target allocation is 35% for Microsoft, 35% for Apple, and 30% for Qualcomm. In the research section, you have news and the different stocks. You can filter it by market cap, price to earning ratio, or dividend yield, or do it by different sectors. And the way it's set up now is sorted by market cap. So Microsoft is the most valuable company at 3.1 trillion. Apple is second, 2.8 trillion. Nvidia at 2 trillion. Amazon at 1.8 trillion. And how much dividend yield. And then funds. The fund section lists all the funds that are available for you. Crypto, I don't do any crypto. In the model portfolio, if you don't want to do much research, there's also several pre-made pies that you can select. And if you scroll down, it'll tell you what they are invested in. If you look at my pie, any pie that I created and used shows here. In any pie that I created but have not used shows up on this section. Let's look at consumers. This was my consumer pie. Keep in mind, this is not an advice. This is not a stock pick fund selection for you. I'm just showing you an example. If you know how to pick stock and you know what funds to select, this is how you create a pie. To build a pie, you click on My Pie. Click on Build Stock and Fund Pie. You can call it whatever you want. My first pie. You can call it, I don't know what I'm doing. I'm just following the market up and the market down. Over time, I will accumulate generational wealth. Click on Add Slice. You can look at stocks to add or funds to add. I'm going to select VTI, which is a total stock market. So VTI, Vanguard Total Stock Market, is essentially track all U.S. companies. Total stock market. When you buy indexes that track the market, when the market goes down, your fund's going to go down. When it goes up, you're going to go up with it as well. When it comes down, you're going to feel the down. When it goes back up, you're going to be, so essentially you are going along with the ride. So you look at VTI, what the current price is, the market cap, dividends yield, so it's paying 1.34%, expense ratio is 0.03, and then you scroll down below, it tells you what company it's invested in, what company it tracks, and what percentages. So Microsoft has 6.29% of Microsoft, 3.07% of Amazon, etc. So I like that. So I'm gonna add that to the basket. And you see here, now it added to the basket. And look at bond, BND. Vanguard Total Bond Market, BND, is essentially tracks a broad market value weighted index of US dollar denomination, investment grade, taxable fixed income securities with maturities of at least 1 year. Let's add that to the basket. That's all I want. That's all I need. Click add. So by default, it's gonna, when you select two funds or two slices, it's gonna divide it up 50-50. This pie is essentially two asset type. One is a total stock market, and the other one is a bond. So you get exposure to the stock, you get exposure to the bond. And the ratio that the expert typically recommend is you want to have the stock to bond ratio where the bond is equal to your age. So if you're a 20-year-old, you want 20% in bond and 80% target for stock. If you're 40 years old, then you want 40% in bond and 60% in stock. Since I am targeting my young 20 and 30s, I'm going to assume my audience is in the 20s, 20% in bond and 80% in stock. So that looks good to me. Save that pie. Since this is going to be your first pie, once you create the pie, you can add that to the portfolio. Obviously, because I already had multiple pies, multiple slices, it cannot exceed 100, so I have to remove 1%. But I'm not going to go through with this. If this is your first time adding pie to your portfolio, you won't have all these. You just have this one here. And that's going to be 100%. So I'm going to cancel out of this one. I don't want to do anything with this. Exit. Yes, I don't want to save anything. Because this is a individual taxable brokerage account, anytime you have dividends or sell profit, keep in mind you're going to have a taxable event where you're going to have to pay capital gain on the profit on the sale. So it's important that you don't click The rebalance here, I mean, you can rebalance, try to rebalance your portfolio. If you click the rebalance button and you have profit, you're gonna create a taxable event and make sure you report that in your tax return for the year that you exercise that stock. As you can see, you can automate your way to wealth. All you need to do is be consistent, dollar cost average into the market, regardless of the macroeconomic factors. As far as dollar amount goes, if you can only afford $20 a week, do it. $40 a week, $50 a week. As time goes by, as years go by, you start to add more and more and more. When you look back 10, 20 years from now, your future self is going to thank you. Over time, you will accumulate enough nest egg to pay for your utilities, your subscriptions, and many other things that life requires. But until then, you need to be intentional in how you live your life. You need to be intentional on what you spend your money on. Money is not everything. You want to splurge on what matters. You want to splurge what brings you fulfillment. But you can afford anything, not everything. And if you buy things with a purpose, the money that you save can be a seed money for your garden of wealth.